December 2nd, 2001. 4,000 people walked into Enron's Houston headquarters expecting a normal workday. By noon, they were unemployed. Just like that, 3 weeks before Christmas. Enron Corporation, valued at over $60 billion just months earlier, collapsed overnight. 4,000 employees were fired immediately. Another 15,000 workers watched their retirement savings evaporate as Enron stock, which made up an average of 63% of their 401k portfolios, became worthless. $74 billion in market value simply vanished. Investors, pension funds, and ordinary workers lost everything. Meanwhile, company executives had quietly sold their shares for hundreds of millions of dollars in the months leading up to the collapse. One employee, Janice Farmer, represents what this meant for real people. 20 years at Enron. Retirement savings, $700,000. Retirement savings after bankruptcy, $20,416. Loss, 97%. Number of employees with similar stories, thousands. Thousands of loyal employees who believed in their company, who invested their futures in Enron stock, lost everything while the men at the top walked away rich. How does a company go from being named America's most innovative company 6 years in a row by Fortune magazine to the biggest corporate bankruptcy in U.S. history? How did Wall Street analysts recommend buying Enron stock right up until the day it collapsed? How did one of the most respected accounting firms in the world help hide billions in debt? And how did three men at the top of Enron convince everyone they were geniuses while they were actually running the most elaborate corporate fraud scheme America had ever seen? This is the story of Enron, a story about greed, deception, and what happens when smart people decide that rules don't apply to them. It's a story about how an entire system failed, from auditors to regulators to politicians. And it's a cautionary tale that we're still ignoring today. Because here's the thing, the patterns that destroyed Enron keep showing up again and again. WorldCom, Lehman Brothers, FTX, different names, same playbook. So let's go back to 1985 and watch how it all began. Let's see how a struggling natural gas company became a Wall Street darling and then a cautionary tale. Let's meet the smartest guys in the room. Spoiler alert, they weren't that smart after all. Houston, Texas, 1985. Two companies nobody cared about merged to create Enron Corporation. Houston Natural Gas and InterNorth, a pipeline company from Omaha, combined their operations. On paper, it looked like a solid deal. In reality, it was a disaster. The newly formed Enron inherited massive debt from both companies. We're talking billions of dollars in obligations. By January 1987, just 2 years after the merger, Moody's downgraded Enron's credit rating to junk status. Junk. That's the financial equivalent of your bank laughing at your loan application. Enter Kenneth Lay. The man who would become the face of corporate fraud in America started out as the American dream personified. Born in 1942 in Missouri, son of a Baptist preacher, grew up poor. Really poor. His family moved constantly as his father searched for churches that could pay him enough to feed his kids. Ken Lay worked his way through the University of Missouri, got his PhD in economics, served in the Navy, worked at the Pentagon, and climbed the corporate ladder. By the time he became CEO of Houston Natural Gas, he was the epitome of the self-made man. Smart, well-connected, friendly, the kind of guy who could charm anyone. But in 1987, Ken Lay had a problem. His company was drowning in debt, and Wall Street was losing faith. He needed a miracle. Or at least, he needed Wall Street to think he had one. This is where the story gets interesting, because instead of actually fixing the company's problems, Lay and his team decided to fix the numbers instead. Let's talk about Enron's first scandal, the one most people don't know about. The one that should have been a warning sign, but instead became a blueprint. In 1987, Enron had a subsidiary called Enron Oil. It was run by two men, Louis Bourget and Thomas Mastroianni. Bourget grew up poor, son of an abusive alcoholic father, worked as a shoe shiner at age 9. He loved playing the role of big-shot oil trader. He kept Dom Perignon champagne and caviar in his office refrigerator. He drove a Mercedes. When another trader asked for the same car, Bourget told him, "Lou is the only one who gets a Mercedes. How about a Cadillac?" That's the kind of guy we're dealing with. Bourget and Mastroianni set up secret bank accounts and started making unauthorized trades. They'd create matched trades, losing money on one contract and making it back on another, all to manipulate when profits showed up in Enron's quarterly reports. They made Enron's numbers look good when the company needed them to look good. And they skimmed about $3.8 million for themselves in the process. Corporate fraud and personal theft, a 2-for-1 special. Here's the crazy part. Enron's management knew about it. They discovered the scheme through an internal audit, but instead of shutting it down, they let it continue. Why? Because the fake profits helped Enron get loans from banks. The company needed Wall Street to believe they were successful, and Borget's schemes helped create that illusion. As long as the money kept flowing, nobody asked too many questions. Then October 1987 happened. Borget got greedy, or maybe he just got stupid. Hard to tell the difference sometimes. He started making massive bets that oil prices would fall, but oil prices kept going up, and as they went up, Borget's losses grew. Instead of cutting his losses like any sane trader would, he doubled down, then doubled down again. Classic gambler logic. I'm already in too deep, might as well go deeper. By the time anyone realized what was happening, Enron Oil had a short position on 84 million barrels of oil. Let me put that in perspective. That's roughly 3 months of production from the entire North Sea oil field off the coast of England. Enron, a company already drowning in $4 billion of debt, was on the hook for potentially another billion in losses. One more billion, and Enron's liabilities would have exceeded the entire value of the company. Game over. They got lucky. Oil prices dropped slightly, just enough for them to close out most of the position. Total damage? About $140 million in losses. Bad, but not fatal. Enron blamed it on unauthorized trading by 2 rogue employees, sued Borget and Mastroeni, and tried to move on. The stock dropped 30%, but the company survived. Here's what's important about this story. This should have been the moment when Enron learned its lesson. This should have been when management said, okay, no more gambling, no more schemes, let's run a legitimate business. But that's not what happened. Instead, they learned a different lesson. They learned that with creative accounting and a little bit of luck, you can hide almost anything. And if you get caught, just blame it on a couple of rogue employees and move on. The Borget disaster was in 1987. The company would spend the next 14 years perfecting the art of fraud until it all came crashing down. But before we get to the crash, we need to talk about the good stuff Enron actually did. Because despite everything we're about to discuss, Enron wasn't just a fraud factory. For a while, they were actually innovating. In the late 1980s, the U.S. government deregulated the natural gas market. Before deregulation, gas was sold through long-term contracts at government-controlled prices. Producers sold to utilities, utilities sold to consumers. Everything was stable and boring and predictable. Then Reagan-era deregulation hit, and suddenly the gas market was open for business. Enron saw an opportunity. They positioned themselves as the middleman. They'd buy gas from producers and sell it to utilities and large consumers, making money on the spread. But more importantly, they pioneered the use of derivatives in the energy market. They created gas futures contracts, allowing companies to hedge against price volatility. It was genuinely innovative. They took financial instruments that existed in other commodities markets and applied them to natural gas. This wasn't fraud. This was legitimate business. Enron was actually solving a real problem. Energy companies needed price certainty. Enron provided it. They built sophisticated trading operations. They hired smart people. They made real money doing legitimate business. Amanda Martin, who worked as an executive at Enron during this period, later said, "This was the most creative period of the company. It fundamentally changed the industry. What happened later, that's where everything went wrong." So let's talk about what went wrong. Let's talk about the man who would turn Enron from an energy company into a house of cards. Let's talk about Jeffrey Skilling. Jeffrey Skilling was a Harvard MBA and a partner at McKinsey & Company, one of the most prestigious consulting firms in the world. McKinsey had been advising Enron on strategy, and Skilling impressed Kenneth Lay so much that Lay offered him a job running a new subsidiary called Enron Finance Corp. Skilling was brilliant. Everyone agreed on that. He was also arrogant, aggressive, and had an ego the size of Texas. Years later, when a reporter asked him about his success, Skilling said, "I've never not been successful at business or work, ever." That's not confidence. That's hubris. That's the kind of statement that the universe eventually punishes. When Fortune magazine wrote a skeptical article about Enron's accounting practices, Skilling called the reporter and said, "The people who ask questions don't understand the company." When she kept asking questions, he called her unethical and hung up on her. Later, he called another reporter an asshole. This was the CEO of a major corporation acting like a teenager who just got grounded. But Skilling was Kenneth Lay's golden boy. He had a vision for transforming Enron from a boring pipeline company into an energy trading powerhouse, and Lay gave him free rein to make it happen. Skilling brought a culture from McKinsey and Harvard that celebrated rule-breaking, not in a good way. Not like innovative, think outside the box rule-breaking. More like, the rules don't apply to us because we're smarter than everyone else. He instituted what Enron called the rank and yank system. Every year, employees were ranked on performance. The bottom 15% were fired. Automatically. Didn't matter if you were good at your job. If you were in the bottom 15% relative to your peers, you were gone. This created a culture of cutthroat competition where employees sabotaged each other and nobody dared question management decisions. Question the boss? Congratulations, you just ranked yourself into the bottom 15%. Here's a detail that perfectly captures how insular and disconnected Enron's leadership became. Jeffrey Skilling, Andrew Fastow, and Kenneth Lay all lived in the same gated community in Houston. The same gated community. It's almost too perfect as a metaphor. These three men, making decisions that would affect thousands of lives and billions of dollars, lived in a literal bubble, separated from the real world by gates and guards. The culture Skilling created attracted a certain type of person: ambitious, aggressive, willing to bend or break rules to win, and Enron recruited them aggressively. They only hired from top business schools, Harvard, Stanford, Wharton. They wined and dined recruits, promised huge bonuses and stock options. A former Enron executive later described the recruiting pitch. "They told us we were the best and brightest. They said if we wanted to be among the elite, this was the place. They fed our egos until we believed we were invincible." Once you were hired, you were in or you were out. There was no middle ground. Work 80-hour weeks, make your numbers. Don't ask questions about how other people make their numbers. If you succeeded, you got rich. If you failed, or worse, if you raised concerns about ethics or legality, you got yanked. One Enron board meeting in 1999, where they voted to suspend the company's ethics code to allow CFO Andrew Fastow to run outside partnerships, lasted 1 hour. 1 hour to approve what would become the central mechanism of Enron's fraud. That's barely enough time to read the proposal, let alone debate its implications. But nobody questioned it, because at Enron, questioning management was career suicide. Now let's talk about the accounting trick that made everything possible. The innovation that turned Enron from a struggling energy company into a Wall Street darling, and eventually, the technique that would help hide billions in losses. We're talking about mark-to-market accounting. Here's how it works. Traditional accounting, called historical cost accounting, values assets at what you paid for them. If you buy an office building for $10 million in 2010, it stays on your books at $10 million. Even if the building is now worth $20 million, your balance sheet still shows $10 million. Conservative, boring, accurate. Mark-to-market accounting is different. You value assets at their current market value. So that building you bought for $10 million? If it's worth $20 million today, you mark it up to $20 million on your balance sheet. That $20 million shows up as an asset, and the $10 million increase shows up as income. You didn't sell the building. You didn't actually make $10 million, but according to your financial statements, you did. For most companies, this method makes sense for certain types of assets, like publicly traded stocks or commodities with transparent prices. The market value is clear and objective. But Enron took this concept and applied it to long-term energy contracts. Contracts that wouldn't pay out for 10, 15, 20 years. Contracts where the future market value was completely subjective. Here's a simple example. Enron signs a contract to supply natural gas to a utility company for 10 years. They estimate this contract will generate $50 million in profit over that decade. Under traditional accounting, they'd recognize that $50 million as income gradually over 10 years, $5 million per year. Under mark-to-market accounting, they could record the entire $50 million as income on the day the contract was signed. See the problem? That $50 million profit projection is just a guess. It's based on assumptions about future gas prices, delivery costs, and a million other variables. But Enron treated these guesses as if they were guaranteed profits and booked them immediately. Even better, or worse depending on your perspective, Enron's executives made these projections. The same executives whose bonuses were based on reported profits. The same executives who were incentivized to inflate the numbers. And the projections never had to be realistic. They just had to be defensible on paper. CFO Magazine actually praised this innovation. They called Enron a pioneer in financial reporting. Wall Street loved it because it made Enron's revenue growth look spectacular. The stock price soared and executives got rich on stock options. But there's another side to mark-to-market accounting. If the market value of your assets goes down, you're supposed to recognize those losses too. If that 10-year gas contract turns out to be worth only $30 million instead of $50 million, you should report a $20 million loss. But Enron didn't like reporting losses, so they found ways to avoid it. Which brings us to Andrew Fastow and the empire of special purpose vehicles. Andrew Fastow joined Enron in 1990, the same year as Jeffrey Skilling. He climbed quickly through the ranks and became chief financial officer in 1998 at age 36. Fastow was smart, wickedly smart. He understood structured finance and complex accounting in ways that most people couldn't comprehend. He also had the personality of a hammer. Former colleagues described him as a screamer who negotiated by intimidation. He wasn't there to make friends. He was there to make numbers work. And make them work, he did. Fastow created a network of special purpose vehicles, or SPVs. These are legal entities, essentially shell companies, created for specific purposes. Legitimate businesses use SPVs all the time for things like securitizing debt or isolating risk. There's nothing inherently illegal about them, but Fastow used them for something else. He used them to hide Enron's debt and inflate its profits. Here's how it worked. Enron would build or buy an asset, let's say a power plant, for $80 million. They'd project it would be worth $100 million, so they'd book $20 million in profit immediately using mark-to-market accounting. But then the project would go badly. Maybe the power plant wasn't profitable. Maybe local residents couldn't afford the electricity. Whatever the reason, the plant was actually only worth $70 million. Enron should recognize a $30 million loss. $10 million below cost, plus $20 million in fake profits they'd already booked. But that would hurt Enron's stock price. It would hurt executive bonuses. It would raise questions about all those other optimistic projections. So instead, Enron would sell the power plant to an SPV for $100 million, confirming the $20 million profit they'd already reported. Where did the SPV get $100 million? From Enron. The SPV would be capitalized with Enron stock or Enron guarantees. Then the SPV would sell the asset for its actual market value of $70 million and somehow make up the $30 million shortfall. Sometimes with more Enron stock, sometimes with promises of future payments, sometimes through incredibly complex structures that even experienced accountants couldn't untangle. The key rule for SPVs was that they had to be independent from the parent company to keep their debt off the parent company's balance sheet. Under accounting rules at the time, an SPV was independent if at least 3% of its capital came from outside investors, just 3%. So Enron would find someone to invest $3 million into an SPV, Enron would provide the other $97 million, and suddenly that $97 million in debt didn't have to appear on Enron's balance sheet. Fastow created dozens of these SPVs. They had names like White Wing, Osprey, and most famously, the Raptors. Yes, Fastow named 4 of his SPVs after velociraptors from Jurassic Park. The irony of naming your fraudulent accounting structures after predatory dinosaurs apparently escaped him. Or maybe he thought it was funny. Hard to say. The Raptors were particularly ingenious, in a completely illegal sort of way. These four entities, Raptor 1 through Raptor 4, were designed to hedge Enron's riskiest investments. Enron had invested in hundreds of technology and telecom companies during the dot-com boom. Many of these investments were tanking by 2000. Enron needed to recognize losses, but losses would hurt the stock price. So the Raptors would provide hedges. They'd promise to pay Enron if these investments lost value. It was like buying insurance, except the insurance company was funded entirely by Enron's stock. If Enron's stock price dropped, the Raptors couldn't pay. It was like insuring your house with a policy that only pays out if your house doesn't burn down. Completely circular and utterly meaningless. But it worked, at least on paper. The Raptors helped Enron hide about $1.2 billion in losses and book nearly $500 million in fake profits. All with Arthur Andersen's approval. We'll get to them in a minute. The most egregious part of Fasto's scheme? He didn't just help Enron, he helped himself. In 1999, Fasto created a fund called LJM, named after his wife Leah and their children Jeffrey and Matthew. How touching. LJM would act as that critical 3% outside investor in Enron's SPVs. Enron would do deals with LJM, and Fasto was on both sides of the negotiation. Think about the conflict of interest here. Fasto was Enron's CFO. His job was to get the best deals for Enron, but he also ran LJM, which needed to make money from deals with Enron. So Fasto negotiated with himself. When Enron sold assets to LJM, did LJM pay a fair price? When LJM provided that 3% capital to SPVs, did it demand adequate returns? Of course not. Fasto structured deals to enrich LJM at Enron's expense. Enron's board knew about this conflict of interest. They had to waive the company's ethics code to allow Fasto to run LJM. They did it in that one-hour meeting I mentioned earlier. And Fasto made at least $45 million personally from LJM partnerships. Some estimates go as high as $60 million. The CFO of a public company was running a side business that made him tens of millions of dollars by doing deals with his own company. And everyone just looked the other way. Why? Because Fasto's schemes made Enron's numbers look good. The stock price kept rising. Executives kept getting rich on stock options. Wall Street analysts kept recommending the stock. Everyone was making money, or at least everyone thought they were making money. In reality, they were building a house of cards that would collapse spectacularly. But before we get to the collapse, we need to talk about Enron's greatest hit, the scheme that hurt real people in their everyday lives. The scheme that showed just how far Enron would go to make a profit. We need to talk about the California energy crisis, the year 2000. California had recently deregulated its electricity market. The idea was that competition would lower prices and improve service. That's what free market advocates promised. Instead, California got rolling blackouts, price spikes, and economic chaos, and Enron was right in the middle of it. Here's how California's deregulation worked, or more accurately, didn't work. Power plants could charge whatever the market would bear, but utilities were required to sell to consumers at fixed, regulated prices. If wholesale prices went up, utilities ate the losses. It was a system practically designed to fail. And Enron, along with other energy traders, exploited every loophole they could find. Enron's traders developed schemes with colorful code names: Fat Boy, Death Star, Get Shorty, Ricochet. These weren't legitimate trading strategies. They were methods to manipulate the energy market and drive up prices. Let me explain one example. Get Shorty worked like this. Enron would buy electricity in California at the regulated low price. Then they'd arrange to export it out of state, even if it just went across the border and immediately came back. Once it was out of state, it was no longer subject to California's price caps. Enron could then sell that same electricity back to California at 10 times the price. They were literally buying low, moving the electricity a few miles and selling high, creating artificial scarcity to inflate prices. Death Star was even more brazen. Enron would get paid to relieve congestion on California's power grid, but they'd create phantom congestion by scheduling energy transfers that they never intended to complete. California would pay them to fix a problem that Enron created. It's like a mechanic who loosens your oil pan, so you'll pay him to tighten it. The result? California experienced more than 35 rolling blackouts between 2000 and 2001. Hundreds of thousands of homes and businesses lost power. Traffic lights went dark. Hospitals ran on backup generators. People died, and Enron traders sat in their Houston offices watching electricity prices spike and celebrating. We know they celebrated because we have the tapes. After Enron collapsed, investigators found recordings of traders' phone calls. The recordings are chilling. In one call, a trader asks another about wildfires shutting down a transmission line. The response? Burn, baby, burn. That's a beautiful thing. In another recording, traders joke about stealing from Grandma Millie and California consumers. There's an email that circulated among Enron traders called the California Sing-Along. It was a parody song mocking California's blackouts set to the tune of Jingle Bells. California's dark, no lights on tonight, our plan just might work and hike up the prices right. They thought it was hilarious. They thought they were clever. Enron made hundreds of millions of dollars from California's crisis. Some estimates put the total damage to California's economy at $40 to $45 billion. Businesses closed, people lost jobs, electricity prices increased by 800% in some areas. And through it all, President Bush's administration refused to intervene. Why? Because Kenneth Lay was George W. Bush's biggest financial supporter. Lay and his wife gave over $600,000 to Bush's campaigns and related political causes. When California's governor pleaded for federal help, the Bush administration said the market should sort itself out. Eventually, in mid-2001, new regulations clamped down on the schemes Enron was using. California started investigating. Federal regulators started asking questions. And suddenly, one of Enron's most profitable operations dried up. That massive revenue stream that had been propping up Enron's growth? Gone. And that's when Enron's house of cards started to wobble. But Enron couldn't have pulled off any of this without help. They needed enablers. They needed respected institutions to vouch for them, to tell investors everything was fine, to look the other way when things got suspicious. They found those enablers on Wall Street and in one of the most respected accounting firms in the world. Let's start with Arthur Andersen. In 2000, Arthur Andersen was one of the Big Five accounting firms. They audited some of the largest companies in the world. Having Arthur Andersen sign off on your financial statements was like having the Good Housekeeping seal of approval. It told investors and regulators that your books were clean. Except Arthur Andersen wasn't really auditing Enron. They were facilitating fraud, and they were getting paid handsomely for it. In 2000 alone, Enron paid Arthur Andersen $52 million. Half of that was for audit services. The other half was for consulting services. Let's pause on that for a second. Your auditor is supposed to be independent. They're supposed to objectively verify that your financial statements are accurate. But Arthur Andersen was also consulting for Enron, helping design the very accounting structures they were supposed to audit. They'd help Enron set up an SPV, then turn around and audit whether that SPV was properly accounted for. It's like a teacher writing your exam and then grading it. It gets worse. Arthur Andersen had a pipeline feeding employees directly into Enron. Dozens of Andersen accountants left to take higher-paying jobs at Enron. The head of Enron's accounting department? Former Arthur Andersen employee. Several other senior finance executives? Former Arthur Andersen. When your auditor is your recruiting agency, objectivity goes out the window. And Arthur Andersen knew what Enron was doing. They had to. They were intimately involved in structuring these deals. Internal emails later released showed Andersen accountants expressing concerns about Enron's accounting, but those concerns never made it into their audit reports. Why? Follow the money. $52 million a year buys a lot of looking the other way. When Enron collapsed and investigations began, Arthur Andersen tried to cover their tracks. They shredded documents. Tons of documents. An Arthur Andersen partner named David Duncan ordered his team to destroy Enron-related emails and papers. They hauled out industrial shredders and worked overtime, destroying evidence. The shredding continued even after Andersen received a subpoena from the SEC. That's not covering your tracks. That's obstruction of justice. The Department of Justice indicted Arthur Andersen in 2002. A jury convicted them of obstruction. The conviction was later overturned by the Supreme Court on a technicality, but it didn't matter. By that point, Arthur Andersen was finished. The firm surrendered its license to audit public companies. 85,000 employees worldwide lost their jobs. 150,000 people if you count related business losses, all because Arthur Andersen chose money over integrity. But Arthur Andersen wasn't the only enabler. Wall Street analysts played along too. For years, even as questions mounted about Enron's business model, analysts kept recommending the stock. Strong buy, outperform, all the way until weeks before the bankruptcy. Why did analysts keep recommending Enron? Because their firms were making a fortune from Enron's investment banking business. Every time Enron wanted to raise capital, sell bonds, or do a merger, they paid investment banks huge fees. Enron spent over $100 million a year on investment banking services. That's a lot of motivation to keep saying nice things about the company. One analyst later admitted, Enron has a simple attitude. We do more than $100 million in investment banking business a year. You'll get your share of that if you rate us a strong buy. That's not analysis. That's pay to play. And everyone knew it, but nobody cared because the money was too good. When journalists or skeptical analysts asked tough questions about Enron's finances, they got stonewalled or attacked. Remember Jeffrey Skilling hanging up on that Fortune reporter? That wasn't an isolated incident. That was standard operating procedure. Enron cultivated a reputation for being prickly and vindictive. Ask too many questions and you might lose access. Write a negative report and your firm might lose banking business. So most analysts played along. Even the few analysts who expressed doubts hedged their criticism. Robert Winters from Bear Stearns wrote that modeling Enron's future earnings is a waste of time, but he didn't downgrade the stock. Another analyst, when asked about Enron's accounting, said, "You have no idea how this works. I have no idea how this works, and I'm not sure the company knows how it works." His firm still rated Enron a buy. So you had Arthur Andersen vouching for the accounting. You had Wall Street analysts recommending the stock. You had credit rating agencies giving Enron investment-grade ratings. You had business magazines naming Enron one of the most innovative companies in America. Enron wasn't just committing fraud, they were getting respected institutions to bless that fraud. And for a while, it worked brilliantly. From 1998 to 2000, Enron's stock price soared. It went up 56% in 1999, then 87% in 2000. By August 2000, Enron stock hit $90 a share. The company's market capitalization exceeded $60 billion. That was 70 times their reported earnings, 6 times their book value. Those numbers should have raised red flags. They didn't. Kenneth Lay, Jeffrey Skilling, and other executives were getting rich. They weren't getting rich from their salaries, though those were substantial. They were getting rich from stock options. And they were quietly selling those stocks while telling employees and investors to buy more. Between 1998 and 2001, Kenneth Lay sold about $300 million worth of Enron stock. Jeffrey Skilling sold about $70 million. Andrew Fastow made at least $45 million from his SPV schemes, plus whatever he made selling stock. Other executives cashed out tens of millions, all while the company was heading toward bankruptcy. But the regular employees, they were encouraged to invest their retirement savings in Enron stock. The company matched 401k contributions with Enron stock. By 2001, the average Enron employee had 63% of their retirement savings in Enron stock. Some employees had 90% or more. They believed in the company. They believed in their leaders. They thought they were building their future. They were actually building a time bomb. And in 2001, the fuse started burning. The first spark came from an unlikely source, a short seller named Jim Chanos. Chanos ran a hedge fund called Kinnikos Associates that specialized in finding overvalued companies and betting against them. In September 2000, he read an article in Texas Journal about gas companies using mark-to-market accounting. Something about Enron's numbers didn't add up. Chanos dug deeper. He looked at Enron's financial statements and saw something strange. Enron reported steadily increasing revenues and profits, But their cash flow told a different story. The company wasn't actually generating cash from operations. In fact, they were burning cash. Their return on capital was terrible. For a company supposedly revolutionizing the energy industry, their actual business seemed to be making very little money. Chanos opened a short position on Enron stock, betting it would fall. Then he shared his research with other investors and with journalists. His work became the basis for an article in Fortune magazine in March 2001 titled, "Is Enron Overpriced?" The article raised simple but devastating questions. How exactly does Enron make money? Why is it so hard to understand their financial statements? Why are analysts so enthusiastic when the numbers are so murky? The article quoted one analyst saying Enron was a big black box. You couldn't see inside to understand how it actually worked. And for a company trading at such a high multiple, that was a huge problem. But Enron's stock barely budged. True believers brushed off the concerns. Skilling called the article unethical, and most investors kept believing. Then in February 2001, something shocking happened. Kenneth Lay stepped down as CEO. Jeffrey Skilling, who had been president and COO, took over as CEO. This was supposed to be Skilling's coronation. He'd built Enron's trading business. He'd created the culture. Now he was running the whole show. Finally, he lasted 6 months. In August 2001, Jeffrey Skilling abruptly resigned as CEO. The official reason was personal and family considerations. The real reason? Probably because he knew what was coming. In the months before his resignation, Skilling sold $60 million worth of Enron stock. He saw the walls closing in, and he got out. Kenneth Lay had to come back as CEO. Again. And on his first day back, he received a letter, an anonymous letter that should have changed everything. The letter was from Sharon Watkins, a vice president in Enron's corporate development group. Watkins had been reviewing some of Enron's SPV transactions and realized something was very wrong. The structures made no sense. The accounting was absurd. The conflicts of interest were blatant. She wrote to Lay, "I am incredibly nervous that we will implode in a wave of accounting scandals." She detailed the problems with the Raptors and other SPVs. She warned that the company could collapse. Lay's response? He had Enron's lawyers investigate whether Watkins could be fired for raising concerns. The lawyers said firing her would look bad, so Lay ignored her warnings and did nothing. He later claimed he thought she was overreacting. "Accounting just doesn't get that creative," he reportedly said. "Ken, buddy, yes it does, especially at your company." But it didn't matter what Lay thought. The problems were real, and they were getting worse. By October 2001, Enron couldn't hide the losses anymore. The Raptors were failing. Enron's tech investments had cratered during the dot-com bust. The SPVs couldn't cover the losses because they were funded with Enron stock, and Enron stock was falling. On October 16, 2001, Enron announced third-quarter results. They reported a $618 million loss. They also announced they were taking a $1.2 billion charge to correct accounting errors related to their SPVs. $1.2 billion in errors. That's not a rounding error. That's fraud. The stock plummeted from $60 in August to $20 by late October. And as the stock fell, things got worse. Many of Enron's deals with banks and investors included triggers. If Enron's stock fell below certain prices, those deals required immediate repayment. Falling stock prices triggered debt payments, which scared investors, which pushed the stock lower, which triggered more debt payments. A classic death spiral. Wall Street finally woke up. Credit rating agencies downgraded Enron's debt. Banks cut off credit lines. Investors ran for the exits. And the Securities and Exchange Commission announced it was opening a formal investigation into Enron's accounting. Enron was hemorrhaging cash. They needed $2 to $3 billion immediately just to stay solvent. They tried to arrange a merger with Dynegy, a smaller energy trading company. Dynegy initially agreed to buy Enron for $9 billion. It seemed like a rescue. But as Dynegy's lawyers reviewed Enron's books, they discovered just how bad things were. One example? Enron had an extravagant severance plan that would cost hundreds of millions if they laid people off. Employees got 2 weeks' pay for every year they'd worked, plus an additional 2 weeks for every $10,000 of base salary. For long-term, high-paid employees, that could mean 6 months or a year of severance. Dynegy realized that Enron was basically a burning building and they'd have to pay enormous sums just to evacuate people. On November 28, 2001, Dynegy walked away from the deal. That was it. Game over. With no merger, no credit, and no cash, Enron filed for Chapter 11 bankruptcy protection on December 2, 2001. At the time, it was the largest bankruptcy in American history, $63 billion in assets, mostly worthless. And it happened fast. In less than 2 months, Enron went from a troubled but functioning company to complete collapse. But here's one of the most infuriating details about the collapse. In late October, during the worst of the crisis, Enron implemented a lockdown on its employee 401k plans. The company was switching administrators for the retirement plans, and during the transition, employees couldn't make any changes to their accounts. They couldn't sell their Enron stock, even as they watched it crash. The lockdown lasted from October 22nd to November 13th, 2001. During that lockdown, Enron stock fell from $15 to $9. Employees watched helplessly as their retirement savings evaporated. They couldn't sell. They couldn't protect themselves. Meanwhile, Enron executives had no such restrictions. They'd been selling stock for months, cashing out while telling employees everything would be fine. When the bankruptcy filing came on December 2nd, 4,000 employees were laid off immediately. Another 15,000 would lose their jobs in the following months. And all of them discovered that their 401k accounts, heavily weighted toward Enron stock, were now worth almost nothing. 20,000 people lost their jobs and their retirement savings in one of the most spectacular corporate failures in history. Janice Farmer wasn't unique. Her story was repeated thousands of times. Longtime employees who'd believed in Enron, who'd trusted their leaders, who'd invested their futures in the company, lost everything. Meanwhile, the executives who created the fraud walked away with hundreds of millions of dollars. For a lot of people, that was the most painful part. Not just losing everything, but knowing that the people responsible got rich while they got destroyed. The fallout was immediate and devastating. Enron's bankruptcy triggered investigations by the FBI, the Department of Justice, the SEC, and Congress. The media descended on Houston. Enron became a symbol of corporate greed and corruption, and people wanted someone to pay. In January 2002, just weeks after the bankruptcy, Enron fired Arthur Andersen as their auditor. Not that it mattered much. Arthur Andersen was already imploding under the weight of their own scandal. But things were about to get even darker. On January 25, 2002, police found J. Clifford Baxter dead in his car. Baxter had been Enron's vice chairman and a senior executive who'd raised concerns about the SPV deals before resigning in 2001. He left a suicide note on the dashboard of his wife's car. "I am so sorry," he wrote. "I feel I just can't go on. I have always tried to do the right thing, but where there once was great pride, now it's gone." Baxter's suicide sent shockwaves through the investigation. Here was a senior executive who'd tried to do the right thing, who'd questioned the fraud, and the pressure destroyed him. His death became a symbol of how toxic Enron's culture had become. Meanwhile, prosecutors were building cases against Enron's leadership. In February 2002, Kenneth Lay appeared before Congress and invoked his Fifth Amendment right against self-incrimination. He wouldn't answer questions. The image of Ken Lay, the guy who'd been buddies with presidents and governors, refusing to testify, was damning. Jeffrey Skilling was charged with 35 counts of fraud and insider trading in February 2004. He pleaded not guilty and claimed he'd done nothing wrong. In his mind, apparently, hiding billions in debt and inflating profits with fake accounting was just aggressive business strategy. Kenneth Lay was indicted in July 2004. 11 charges including conspiracy, securities fraud, wire fraud, and making false statements. He also pleaded not guilty. Like Skilling, Lay seemed genuinely unable to understand that what they'd done was criminal. In their minds, they were visionaries who'd been brought down by jealous regulators and a misunderstanding public. The trial began in 2006. For months, prosecutors laid out the scheme in excruciating detail. The fake profits, the hidden debt, the manipulation, the lies to investors. They showed emails, played recorded phone calls, brought in witness after witness. Former executives testified about the pressure to make the numbers work, the culture of fear, the willingness to do whatever it took to keep the stock price up. Skilling and Lay testified in their own defense. Both claimed they didn't know about the fraud. They blamed Andrew Fastow and other subordinates. They said the collapse was caused by a loss of confidence, not by anything they'd done wrong. The jury didn't buy it. On May 25, 2006, both Skilling and Lay were convicted. Skilling was found guilty of 19 counts, including conspiracy, fraud, and insider trading. Lay was convicted on 6 counts of fraud and conspiracy. Both men faced decades in prison. But Kenneth Lay never went to prison. On July 5, 2006, while vacationing in Colorado and awaiting sentencing, Lay died of a heart attack. He was 64 years old. Because he died before sentencing, his conviction was vacated. In the eyes of the law, Kenneth Lay died an innocent man. His widow was able to keep much of their wealth. For the people who lost everything because of Enron, it felt like Lay had gotten away with it, even in death. Jeffrey Skilling was sentenced to 24 years in prison and ordered to pay $45 million in restitution. After appeals and a deal with prosecutors, where he agreed to stop fighting his conviction, his sentence was reduced to 14 years. He was released in February 2019 after serving 12 years. And where is Jeffrey Skilling now? He's back in the energy business. In 2020, he launched a new company focused on digital energy trading. Some things never change. Andrew Fastow, the architect of the SPV schemes, cut a deal with prosecutors. He pleaded guilty to 2 counts of conspiracy, agreed to forfeit $23.8 million, and was sentenced to 6 years in federal prison. He served 5 years and was released in 2011. And here's the kicker. Andrew Fastow, the guy who helped orchestrate one of the biggest frauds in corporate history, now gives speeches about business ethics. He travels around to business schools and conferences talking about what went wrong at Enron and how to avoid similar mistakes. The irony is so thick you could cut it with a knife. But apparently, he's quite good at it. Former fraudsters often make compelling speakers because they know all the tricks. As for Arthur Andersen, the firm dissolved. 85,000 people lost their jobs. The company that had been auditing major corporations since 1913 ceased to exist. Their conviction for obstruction of justice was overturned by the Supreme Court in 2005, but by then, it was too late. Once clients lose trust in an accounting firm, that firm is finished. Arthur Andersen became a cautionary tale about the importance of auditor independence. The banks that financed Enron's schemes, they paid settlements, but nobody went to jail. JP Morgan Chase paid $2.2 billion. Citigroup paid $2 billion. Canadian Imperial Bank of Commerce paid $2.4 billion. These banks had structured deals to help Enron hide debt and inflate cash flow. They knew what they were doing, but they were too big, too important to the financial system. So they wrote checks and promised to reform their practices. Reform. That's a nice word. After Enron collapsed, everyone talked about reform. Congress held hearings, regulators promised changes, business schools added ethics courses, and in July 2002, President Bush signed the Sarbanes-Oxley Act into law. Sarbanes-Oxley, often called SOX, was the most significant reform of corporate accounting since the 1930s. The law required CEOs and CFOs to personally certify their financial statements. If those statements were fraudulent, executives could face criminal penalties. It mandated better internal controls over financial reporting. It created the Public Company Accounting Oversight Board to regulate auditors. It protected whistleblowers from retaliation. It required companies to disclose off-balance sheet arrangements. All of these provisions were designed to prevent another Enron, and for a while they seemed to work. Companies became more careful with their accounting. Auditors became slightly more independent. Whistleblowers had legal protection. But Sarbanes-Oxley also had costs. Compliance was expensive, especially for smaller public companies. Some critics argued the law was too broad, too burdensome. Others said it didn't go far enough to address the fundamental problems in corporate governance and Wall Street culture. And here's the thing. Sarbanes-Oxley didn't prevent the 2008 financial crisis. It didn't stop Bernie Madoff from running a $65 billion Ponzi scheme. It didn't prevent the collapse of Lehman Brothers, or Washington Mutual, or Bear Stearns. Different frauds, different mechanisms, same fundamental problem. When incentives reward short-term profits over long-term sustainability, when executives can get rich by taking enormous risks with other people's money, when regulators are captured by the industries they're supposed to regulate, bad things happen. Enron became a cultural touchstone. Time magazine named 3 whistleblowers as their Persons of the Year for 2002. Sharon Watkins, along with FBI agent Colleen Rowley and WorldCom internal auditor Cynthia Cooper, were celebrated for speaking truth to power. The message was clear: we need more people willing to raise alarms when they see wrongdoing. Enron inspired books, documentaries, even a musical. Yes, a musical. Enron opened on Broadway in 2010 and closed after 12 days. Apparently, audiences weren't ready for singing and dancing about corporate fraud. Who knew? The company's logo became synonymous with corporate evil. When Sam Esmail created the TV series Mr. Robot, he based the logo of the fictional evil corp on Enron's logo. That tilted E became a symbol of everything wrong with American capitalism. But what did we actually learn from Enron? That's the question we should be asking. Because looking at corporate America today, it's not clear we learned much. The fundamental problems that enabled Enron still exist. Executives are still compensated primarily through stock options, creating incentives to inflate short-term stock prices. Auditors still provide consulting services to companies they audit, creating conflicts of interest. Wall Street analysts still work for firms that want investment banking business from the companies they cover. Credit rating agencies are still paid by the companies whose debt they rate. Corporate boards are still often filled with friends of the CEO who don't ask tough questions. And we keep seeing the same patterns. In 2002, just months after Enron collapsed, WorldCom filed for bankruptcy after revealing an $11 billion accounting fraud. In 2008, Lehman Brothers collapsed after hiding billions in liabilities. In 2015, Theranos was exposed for faking blood test results and lying to investors. In 2022, FTX imploded after its founder used customer funds to make risky bets and buy real estate. Different industries, different schemes, but the same core elements. Charismatic leaders who claim to be revolutionizing their industries. Complex financial structures that nobody fully understands. Auditors and advisors who are too conflicted to be objective. Regulators who are understaffed, outgunned, and sometimes captured by industry. Investors who want to believe the hype. Employees who trust their leaders. And a culture that celebrates wealth creation without asking too many questions about how that wealth was created. 23 years after Enron's bankruptcy, we're still having the same conversations about corporate governance, auditor independence, executive compensation, and financial regulation. We passed Sarbanes-Oxley. We passed Dodd-Frank after the financial crisis. We've had countless reforms and new rules, but we haven't addressed the fundamental incentive structures that make fraud attractive and profitable for the people at the top. Here's what makes Enron's story so important. It wasn't just about 3 bad guys who committed fraud. Ken Lay, Jeff Skilling, and Andy Fastow didn't act alone. They had help from Arthur Andersen, from Wall Street banks, from credit rating agencies, from analysts, from board members who should have been asking questions but didn't. They had help from a political system that prioritized deregulation over oversight. They had help from a business culture that celebrated aggressive deal-making and looked the other way when the deals seemed too good to be true. Enron was a systemic failure, and treating it as just a story about individual bad actors misses the point. Yes, Lay, Skilling, and Fastow made choices. They chose fraud over honesty. They chose personal wealth over their responsibilities to employees, investors, and the public. They deserve the consequences they faced. But the system that enabled them, rewarded them, and protected them for so long, that system is still in place, with some tweaks, some reforms, some additional disclosure requirements, but fundamentally, the incentives remain the same. We learned from Enron that accounting can be manipulated, that auditors can be compromised, that complex financial structures can hide enormous problems, that executives will lie to protect their wealth and reputations, That Wall Street will look the other way as long as the fees keep flowing. That regulators are often late to catch fraud. That by the time the truth comes out, the people responsible have usually already cashed out. Those were valuable lessons. But we haven't applied them. Or maybe we've applied them in narrow ways that make us feel better without actually solving the underlying problems. The tragedy of Enron isn't just that 20,000 people lost their jobs and retirement savings. It's not just that investors lost $74 billion. It's not even that a company with real innovations and smart people destroyed itself through greed and fraud. The tragedy is that we didn't really learn. We keep making the same mistakes. We keep trusting leaders who tell us they've found a way to make extraordinary profits with minimal risk. We keep assuming that smart, successful people must be honest. We keep believing that this time is different. It's never different. The details change. The industries change. The names change. But the pattern is always the same. Hype and confidence, rising stock prices and aggressive accounting, warning signs ignored until it's too late, and then collapse, investigation, and promises to do better next time. Enron should have been a wake-up call. It was for a moment. But we hit snooze and went back to sleep. And that's why studying Enron isn't just about understanding history. It's about recognizing patterns that are still playing out today. The next Enron is probably out there right now. Some company with a charismatic CEO, a complex business model that analysts don't fully understand, accounting that seems aggressive but gets blessed by respected auditors, and a stock price that keeps climbing even though the fundamentals don't quite add up. Will we catch it before it collapses? Maybe. Will we prevent it from causing massive harm? Probably not, because preventing fraud requires more than rules and regulations. It requires a culture that values transparency over opacity, long-term sustainability over short-term gains, and honesty over cleverness. We don't have that culture. Not in corporate America, not on Wall Street, not in our regulatory agencies. So here we are, 23 years after Enron's bankruptcy, and the smartest guys in the room are still making the same mistakes. Or maybe not mistakes. Maybe they've learned from Enron that you can commit fraud, get rich, serve a relatively short prison sentence, and then get back to business. Maybe that's the real lesson of Enron. Not that fraud doesn't pay, but that for the people at the top, the rewards often outweigh the risks. That's a depressing thought, but it's one we need to confront if we want to prevent the next Enron. We need to ask hard questions about who we trust, why we trust them, and what incentives we create for people in positions of power. We need to demand more transparency, more accountability, and harsher consequences for fraud. And we need to remember that when someone tells you they've figured out how to print money, they're probably printing fake money. Enron collapsed on December 2, 2001. The company is gone. The executives are dead, in prison, or giving speeches about ethics. The employees who lost everything have mostly moved on, carrying the scars of betrayal and financial ruin. The investors who believed the hype learned an expensive lesson about due diligence. And the rest of us got a case study in how badly things can go wrong when ambition, greed, and fraud collide with insufficient oversight. The question isn't whether there will be another Enron. There will be. The question is whether we'll recognize it in time, and whether we'll have the courage to do something about it. Based on history, I'm not optimistic, but maybe, just maybe, by understanding how Enron happened, by seeing the warning signs and the patterns, we can be a little more skeptical next time someone promises revolutionary returns with no risk. Because as Enron proved, there's no such thing as a free lunch. Someone always pays. And it's usually not the people at the top. That's the story of Enron. The smartest guys in the room who weren't smart enough to realize that every house of cards eventually collapses. The employees who trusted their leaders and paid the price. The system that enabled fraud and barely changed afterward. And a lesson that we keep forgetting, over and over again. Remember Enron. Not just as a story of corporate fraud, but as a mirror reflecting the problems we still haven't fixed. Because until we address those problems, we're just waiting for the next scandal, the next collapse, the next time thousands of people lose everything because a few people at the top decided rules were for other people. And that's not just bad business. That's a failure of our entire system. Enron didn't happen in a vacuum. It happened because we built a system that made it possible, profitable, and almost inevitable. Until we change that system, Enron's story isn't over. It's just intermission.